My name is Livea Coda, Market Intelligence Analyst responsible for sugar and ethanol. And in this second panel, we are going to explore the sugar market. I will start by discussing some of the main fundamentals that led us to our global sugar balance and trade flow views. Right after, Fabio Mendes, our head of sugar desk, will explore prices, ranges, and parities, discussing how our fundamentals impact expectations. So let's start. First, we are going to recap what happened in 2021 and what led us to revise our numbers and reach the prices we did. Then, we will move to what to expect in the main producers. We will look with a bit more details into Brazil, one of the hot topics at the moment, and with all that construct our base case view for global S&D and trade flows. Then, we're going to play a little with numbers in order to understand where the main risks are. Fabio will take over from that and show more of prices and parities. So starting with our recap, at the beginning of 2021, we expected the 2021 crop season to be a deficit. We had demand recovery together with some crop breaks to sustain that. At the same time, some central banks already found the need to start hiking rates. Close to March, we knew Brazil 2021 April-March was a record, and we expected a good 21-22 crop season, so global sugar balance could be a surplus finally. In April, however, drought effects became more evident, and markets started to reduce crop prospects. Ethanol prices rose with lower stocks perspective. Global congestion reached all-time highs in June, and container rates skyrocketed. In July, Brazil got hit by frosts and market showed signs of concerns that were added with fires on August. These concerns lowered Brazil crop prospects to 525 million tons. Amid economic slowdown, Evergrande came to make market even more worried, starting a cycle of higher risk perception and dollar strengthening. Oil complications became more evident in Brazilian domestic market around October. Prices hiked, while Northern Hemisphere crop began. Fed announced a tapering close to the end of the year, while a new COVID-19 variant showed its face and induced market liquidation. If you look closely, prices kept within an 18.8 cents per pound to 20.5, but ever since mid-December, it has failed to recover because we had Northern Hemisphere crop showing signs of good pace. India had by then already contracted 3.8 million tons of sugar, and ethanol stocks in Brazil seems to be smoother. So prices started to transit into a new range. What can we expect for 2022? Well, I'll start with basic fundamentals. And before we reach sugar market, we'll talk a little bit about macro. So first of all, we should expect a recovery in some economies such as China. They have already indicated that they are ready to adopt expansionary fiscal policy, what is good news for commodity exporting countries. However, we have a persistent inflation to look out for. Since its cause is mainly stressed supply chains, we should see some endurance. This could induce more defensive trading and attract some capital to less cyclical assets. But how is our sugar market? How are our fundamentals, right? So let's start with some important countries and regions to explain better the rationale behind our global S&D numbers. First, European Union and the UK. We had weather improvements as well as emergency use of pesticides that contributes to better yields. 11.22 tons per hectare is our current view. Even if it doesn't represent average, going back to average yields, this could guarantee a recovery from 14.3 to 15.2 million tons of sugar, already considering ethanol diversion. In terms of consumption, however, they should remain in recovery, yet the slow pace would prevent them from reaching pre-pandemic levels. On the other hand, showed some good results so far. Yields recovered 12.9% and area about 8.5%, according to official data. We expect production to reach ICAR's numbers. ICARS is the Institute for Agricultural Market Studies, and they predict 5.7 million tons of sugar production, meaning that the country should keep imports and export stable. Our USA vision is quite in line with the USDA, and since a strong end in Louisiana campaign is expected, production could reach higher levels. So we expect 8.5 million tons of sugar production. More domestic availability means less need of imports, and a quite stable exports and delivery guarantee 14.4% stock-to-use ratio. When we go to Mexico, yields are reported to be better when compared to last year, and so far, production has improved nearly 1%. But keep in mind that there was a delay due to rains at the beginning of the crop. Overall, an increase is expected. We should see production recovering to past highs around 6.1 million tons. That is 400 tons more than K-tons more than what we did last year, and also means more availability. When we go down to Central America, the main producers are showing the first signs of investment returns. We expect increases of 3 and 4% in Guatemala and El Salvador, and this also means that we will have more availability coming from these two countries. The major investments made were on irrigation technology as well as in cane yield development in both countries. When we go to the main producer doing Brazilian intercrop, India, most regions have shown improvements that support a higher production estimate when compared to last year. We expect 32.2 million tons of cane and a diversion of 3.5 million tons. Ever since frosts and fires hit Brazilian crop, prices became favorable for Indian export even without subsidy. So far, the country is known to have sold 4.6 million tons of sugar that should leave the country until April. They clearly took advantage of prices and contributed to smoothing Brazilian absence. So we expect a lot of sugar coming from this country at least until April. When we go to Thailand, we also see signs of recovery with a good pace supporting these prospects. Yields are reported to be slightly above last year, and production expected to recover 2.2 million tons, reaching 9.9 and leaving 6.7 to be exported. A huge amount of availability when compared to last year that they only did almost 4 million tons exports. We also expect most of the sugar to be delivered between January and March, taking advantage of prices and Brazilian absence. When we look into the main destination, the main importer, China, their crop was affected by adverse weather, leading them to lose part of their production and lowering it year on year. So we expect 10 million tons when compared to 10.7 last year. There is still a downside risk since weather hasn't improved, and this might explain why until December they haven't stepped down their import pace, remaining above average. However, we should keep in mind that they did build up stocks in 2021, importing more than their available quotas even with closed arbitrage. This situation is a risk for the import pace that we are estimating here. Yet, looking at the current briefing, we do believe that they will keep importing, especially with the economic recovery prospect as we discussed in the beginning of the presentation. Now, giving a little bit of a deep dive in Brazil, this season is almost over and we expect sugar production to reach 525 million tons of cane. For the next one, our estimates indicates a recovery to 551 million tons. We consider the rate of recovery throughout history since 2008-9 and estimate that we shouldn't reach more than 7.1% yield recovery. This leads us to 72.3 tons per hectare. As to area, as Unica mentioned, we should see some reduction around 2%, mostly due to renovation. This renovation will take place once frost struck an already suffering cane. We had an extensive period of lower rains before and after the frost, we also had fires. Though the age won't justify cane area renovation just yet, this adverse weather plus logistic effects would induce them to do so. Also, rains have improved since the closing of 2021, so we should expect lower ATR as well. Prices did remain favorable to sugar, and given comfortable stocks in ethanol and not a great increase in fuel demand, sugar mix should remain sweet, close to 46%. Note that any major changes in the macro or energy scenario could offer support to ethanol prices, and thus, inside the deficit year, could represent support for sugar. This is a summary of what we expect for the next season in terms of fuel demand. We expect only a 1.1% increase in 2023. And if we do have pump prices remaining favorable for gasoline C, we could see some changes in anhydrous and hydrous share, as we did the past year. So we do see 46% of sugar mix in a 551 million tons of cane, and that should give us 33.8 million tons of sugar. Right now, assuming that we will have almost non growth in fuel demand, 1.1, we should have 9.2 on hydrous and 15.3 hydrous. If we do have more pump parity for gasoline C, then we should have a change between those two numbers. We could have more anhydrous and less hydrous. When we go to stocks, sugar stocks are slightly more pressured, and we expect exports to reach only 24.6 million tons in 22-23. That given that we have 33.8 million tons production. Anhydrous and hydrous stock, with the numbers that we showed you on the last slide, should remain within 9-year average. So to summarize, we have a third-year deficit with a reduction in stock-to-use ratio that could be seen as bullish. Fabio will explore a bit more this factor in his presentation. For the time being, our view, most countries actually register an increase versus the past October-September crop year, except for Brazil and China. We also are considering 1.1% growth in world consumption. So we do have a deficit, and this deficit is not a huge one, but is there of 1.4%, 1.4 million tons, sorry. When we move to the next slide and we look into trade flows, however, the pressure that we see of a deficit is alleviated from Q2 on. Brazilian Center-South returns and this return is actually already affecting N2 V2 spread, the deferred spread, as lack of viability is expecting to smoothen from Q2 onwards. This view includes China keeping its import pace, India taking advantage of prices and sailing 4.6 million tons until April, Thailand, Mexico, and Centrals also trying to take advantage of prices. This is our base case. This is what we as HedgePoint believe. So we should see Q1 still a little bit pressured and giving some support to flat prices, but as we are already seeing deferred spreads, we should see this pressure alleviated from Q2 onwards with Brazilian comeback. But what about other outcomes? What if we have Brazilians suffering another crop break? What if Brazil find more cane, if we recover more? What if China changes its import pace? Well, we'll explore some extreme cases here just to see what would change in our trade flows, okay? So this one you already know, it's our base case. Fed prices should find some support until Brazil come back, and this already added pressure in deferred spreads, right? This other one is, what if Brazil suffers another break? Then if China keeps its pace, we could have a constructive scenario. But given that rains have been better, it is highly unlikely so far that we stuck to another bad year. Of course, that it happened last year, so it's something that we should keep in mind. If Brazil is out of the picture again, then we probably would have a constructive scenario, right? But let's hope for the best here. What if Brazil has a better recovery than expected and China does not import as much? then we would be entering a bear scenario. This would add much pressure to the fruit spread, and we could see ethanol really pressuring sugar, right? Our deficit would be way lower, and any change could lead us to surplus. So we would be in a 0.4 million tons of deficit. Any changes in production, if Thailand gets a little bit more, if China doesn't break as much, anything could change us from deficit to surplus if Brazil comes with 570 million tons of cane. And why believe in our base case? First, given all the cane has been through, we are still skeptical of a great huge comeback from Brazil. Given that stocks don't seem to be a problem for China and their economic recovery, and they're facing an economic recovery year, at least we expect that, and a bad crop prospect, it is likely that they will keep import and that they will do more than the average. Therefore, our view, and Fabio will explore this further, is that we do have support for the short run, but with Brazil recovery, we could be moving to a lower range. Short-term fundamentals, therefore, remain bullish. Lower availability suggests that any additional demand to restock, as an example, would need to reach Indian prices. Yet, they already sold a lot of sugar, and Northern Hemisphere crop as a whole give us evidence of recovery, smoothing this pressure. Higher oil prices and global recovery might add support, while risk perception is a threat to funds positioning. We should keep an eye on Brazilian weather and possible cane outcome, but the message remains we could be entering a range transition period, and to talk more about that, we have Fabio Mendes, head of Sugar Desk. Meanwhile, I only thank you for your presence, and I leave you with Fabio now. Thanks.
Thank you very much, Livea. It's a great pleasure to be here. Thanks to our participants as well. I hope you have enjoyed so far. My name is Fabio Mendes, and I am the Latam Sugar and Ethanol Head Desk for HedgePoint. And I will be conducting this next panel on sugar market. So moving to our agenda, we will go through some topics as how has 2021 events impacted the sugar prices? Then a little on recent positioning versus global S&D, as Livea just showed us. We go also through prices and what do they are telling us. We're going to touch a little bit about the basis behavior. And finally, most important part, I think it's what to expect, what's next. And then summarize it up by the end of the presentation. So going into the subject itself, let's start talking about the raw sugar prices. And I think worth mentioning that the 2021 was a great year for the millers on the price perspective. Although we have less cane available, the combination of higher sugar prices and the BRL devaluation increased their gains. Also, the domestic ethanol prices helped a lot into this equation. So it was a perfect year for the millers to, one, generate positive cash flows, and two, to liquidate some short-term debt as well. From the 2022 year, though, we do expect a delay on the start of the season, as the cane fields need more time to recover from the last year drought, fires, frost, which is normal and regular. We also notice that the sector are less priced than the last year, with mills waiting to have a clear view on their crushing numbers and also being badly hurt by their margin calls last year as well. And finally, the parties are pointing out to another max sugar season, but it is not 100% defined. Let's see some aspect into more detail. Now going straight to this year. What we see, as Livea just showed us before, is a deficit in the global S&D. This lack of sugar is not as great as we and the market were expecting by the end of 2021, and that is already reflecting on prices and on the net spec positioning. Clearly, there is a trend of being long in Death Star years as this one. However, we are facing some adverse context outside the sugar sector, just like global raising inflation, central banks making a stand, and higher risk perception. All this together contributes to a lower, if not short spec. Current net spec position is the smallest one since the midst of 2020, with a total of roughly 45,000 lots long year to date. So moving forward to prices, and let's discuss a little bit about the stock to use. Usually they do reflect this lack of availability, especially when there is a demand for restocking. However, 26% stock to use ratio is above the lowest level ever seen back in 2015-2016 crop, and we still find some quietness in the physical market. This lower trade rate, as well as the risk sentiment, has contributed to prices falling into a new range, as we are going to see in this next slide. We're going to talk a little bit about the spreads as well. If you look in the first graph, you can see that we left 2021 at a 19.5 to a 20.5 cents per pound range. And ever since the market became more bearish, with a good Northern Hemisphere crop, better prospects for Brazilian 22-23 season, together with an increase in the risk perception and the fund sellout, we move into a new range between 17.8 and 19.3 cents per pound. Yet, if we look closely to the number, 18 cents is still higher than what we would get back in 1920 and 2021 as well. This lack of availability has given some support to flat prices and the nearby spreads as well, as we can see in the two other charts showing March, May, and July OC spreads. So, talking a little bit about the basis, FOB Santos. If the demands pick up in the short term, Brazil has almost nothing left to cover. And then prices would have to reach the Indian export parity, remaining closer to the highest end of the range, and some FOB correction could happen. We are almost at the end of Feb, and the prompt basis haven't shown any signs of major improvement so far. So what to expect? This chart is for the short run, right? Funds selling pressuring the prices, and demand offers support. Depending on the demand, we could be closer to the highest or the lower side of the range. But what about from mid-May onwards? Well then, we will have Chinese arbitrage and ethanol fighting to be the floor, whichever pays the most. Simple as that, period. So what to expect about the cycle, the auto cycle demand? When we talk about ethanol consumption, although 2021 was a recovery year with a better performance compared to the 2020, it is far from 2019 pre-COVID levels. From 22-23, on the demand on the ethanol side, we don't expect to be much improvement when it comes to the fuel demand, due to Brazilian low economic growth and purchase power losses would prevent a recovery to pre-COVID levels, helping stocks to remain comfortable for both hydrous and anhydrous products. In addition to that, 2022 is probably going to be an unstable year in the domestic market due to elections and the high inflation. So what to expect on raw sugar and price parities? This slow fuel demand recovery is rather bearish and could mean that Chinese ARB should remain as the floor. However, ethanol might find support on the oil inflation And depending on the recent geopolitical events, this could be intensified. So what to expect if the ethanol prices get pressured and the sugar demand does not recover? While the sugar market might take the tool for rising inflation and risk perception, especially when it comes to fund positioning, ethanol prices could remain supported, especially if Petrobras nets its import arbitrage, as we can clearly see the difference of the charts above. We can see that the difference between the both products narrow big time when Petrobras nets its import arbitrage. So what to expect of Chinese arbitrage then? Yet, if the demand shows signs of gaining some traction again, we could expect trade flows to remain tight and therefore be bullish for prices, right? In the case it doesn't, then we might as well go back to the previous scenario and have ethanol as a floor. Why can the Chinese arbitrage still be the floor? Our current view is that we should see some demand, especially from China, that has not reduced its pace even during a long period of closed arbitrage. With bad production prospect, as Livea showed us in detail on her presentation, the country might remain buying and restocking. So in this slide, we try to put in very clear way in bullet points the bulls and bears factor. In the end, we have some points to keep monitoring: demand, risk perception, and the oil market. It is quite good battlefield for bulls and bears. However, we do believe that we are moving to an even lower range, especially due to risk perception and demand quietness, also high sea freight costs. Although it could be seen as a bear perspective, prices remain above what we saw in the past years. So thank you very much for your attention so far. I hope you have enjoyed it as well. And now Livia and I will be open for the Q&A panel.
Hi, everyone. Let's just wait a little bit for Fabio. Hi, Fabio. Great presentation.
Livia.
Hi, everyone. We are now here to answer all your questions on the Q&A. Let's see if we do have our first one. Oh, here. So this one, I think it's more for you, Fabio. How BRL and other emerging market currencies can influence the sugar and ethanol market? Can you take this one?
So this is yeah, I will. This is a nice one. So the more devaluated a currency is, it's clear that the more you get by selling to the international market, right? So when we look into Brazil, weak BRL make it more interesting for mills to export their product, their sugar. So we can expect maybe the little change in the mix of production, yes, respecting a minimum and max capacity that the country can export. But we do also increase the cost of production. That's something that we need to bear in mind, right? Because fertilizers and the oil, they became more expensive. Therefore, they impact the production. So if you compare to other emerging countries, then we'll be talking about the market share, in my view. So it's all about the market share. A devaluated BRL makes possible to Brazil to export more, right? And then rises its participation in the global trade flow. But the last but not least point is that since we are entering a year of high volatility here into the domestic market, simply because of the elections, I think it's even harder to try to figure out the BRL behavior throughout 2022, Livea. That's it.
Okay, so we're going to go to the second question we received. This one, I think it's more for me, but if you feel you can jump in, please do. On the Brazilian domestic market, how do you see the proposed constitutional amendment as to fuel prices affecting the ethanol market? So for now, we have 4 projects going on, and they're trying to approve 4 different projects that could influence the prices we have in domestic market for fuel, not only ethanol, but gasoline and diesel as well. And the one that's having more, that's hitting more the spotlight, it's the one proposed by Aureus. And this one says that we could reduce the taxes or even take away all of it through the price formation of gasoline and ethanol, right? So here inside HedgePoint, we made a simulation, a very quick simulation, nothing much fancy, but what would happen if we took away all the federal tax that we have in gasoline C and ethanol price formation. That showed us that we would have a price at the pump around 10% lower. That would be around 65 cents of reais per liter in gasoline and 45 cents per reais on ethanol, right? And that would also reflect in a 7.7% lower prices at the mill for ethanol. So if this lower prices, right, although it's not much of an impact, this lower prices, it could somehow induce more demand. But if we look into the year that we're heading on to, actually that we are in 2022, we had a population losing purchasing power, and we have inflation prospects pretty high, and also low GDP growth. So all these lead us to believing that we won't have a good recovery in fuel consumption. So with stocks in ethanol rather comfortable and this lower prices not being as much of an impact, we probably could see mills showing up for sugar, so maintaining a sugar mix more sweet, right? And if we investigate even further the cause of this high prices in fuel, we can see that it's not only the tax that's causing it. We do have an impact of higher prices of oil in the international market, and the devaluated BRL also contributes to this these high prices, reflecting even higher inside our country, right? So I guess this is it for this question, right? The next up here that we have is, what can we expect if Russia and Ukraine's tensions escalate? Could it affect trade flows? The trade flow part, I think I'm going to take, and the other part I'm going to leave Fabio. So when we talk about trade flows, both Russia and Ukraine, they are very important on the Black Sea region. But when you look into the total trade flows, if we take them away or change anything about them, it wouldn't change much of the picture. So I believe the trade flows wouldn't be much impacted when considering these two countries, right? But we would have impact if a war were to come over other kinds of metrics, other kinds of indices that might somehow make changes in trade flows. What do you say, Fabio?
Yeah, this is a trick one. I think that the impact we could see more specific in the sugar market, is likely more indirect, like capital flow, because of these geopolitical issues. They are known to increase the risk perception. I think in this context, like less cyclical investment, it's getting into the spotlight. Dollar, metals, energy usually still the same here. So I think that the speculators, the fund may rise in their position there as well, while cyclical commodities, as the soft ones, end up on the downside. I think this is the risk aversion behavior. that could induce therefore position swift and then end by affecting the prices. I think this is it.
Perfect. Okay, let me see. We do have another one. Why are Brazilian mills taking their time to price hedge? I think this one's for you, Fabio.
Yeah, the mill seems to be well priced already, Livea. However, it's lower than last year. This is our perception. And we believe that it's due to caution, as you presented over our presentation. Mills, they aren't yet certain of how much recovery the cane field is going to show. Therefore, they are slowing down the hedging pace, as well as they have been hurting a big time with margin calls last year. I think this is it.
So I think we have time for last one. Let me see. They're asking what could make us change our view? What could make us more bullish? Okay, so there are three main risks to the view that we presented you guys. The first one would be demand, the second weather, and the third one I would say it's geopolitical. So if we look into demand, if we do have an awakening, if destinations start buying more because they want to restock, as we showed, the stock to use is rather low, then we could see some more pressure in our trade flows. Our trade flows were accounting for China bringing up more demand than their average. But for the other countries, we were sticking to a rather well-behaved demand. So if they start showing up, then we could see probably a small deficit in Q3 and maybe something on Q4 that might give some strength to different spreads, right? The other part is weather. So as we talked in the presentation, we could still see Brazil having an impact of weather, either bad or good. So we could see our production of cane, our total cane numbers going up. And if we do have more availability, obviously then it's more bearish. But if we do see something like frosts or something like fires at the end of the year and that actually bring our cane down, then we could become more bullish. And it's not only Brazil on the equation, we still have other countries, we still have Thailand, we still have China that's showing bad crop progress. China, I mean, showing bad crop progress, that this all could also change for a slightly more bullish. And as we talked, I think on the third or second question about geopolitical issues, we do have a pretty intense scenario right now, and anything could actually change. If we have a high risk perception, then we could have on the macro side some capital rearrangement. So we could see some funds liquidation, right? And that could affect prices in the short term. But if this also means that we'll have higher oil prices in the future, then that can actually be bullish for us. So all these are risks to the field that we showed you guys and needs to be monitored. So I guess this is it for today. We do have some questions that we'll answer by email. If you guys want to get in touch with us or send any more questions, you can use the QR code that we have on the screen. The QR code, yeah, the QR code that just appeared on the screen. So if you guys want to get in touch, if you want to make suggestions, if you want to make further questions, we'll answer it all by email and we'll read all the comments. So please get in touch with us through the QR code.